There's a saying, out with the old, in with the new. That's often good advice, but in crypto, it's not so clear. Old tokens usually have listings, liquidity, and brand. Meanwhile, new tokens often have price momentum, mimetic power, and user growth. So which is best? Today, we're pitting old versus new cryptos across 5 metrics in an attempt to answer exactly that. My name is Lewis, and if you're building a crypto portfolio, this is one video you cannot afford to miss. First up though, I am not a financial advisor and nothing in this video should be considered financial advice. This is purely educational content meant to inform you about how old cryptos compare to newer cryptos. And if that sounds good, then hit that like and subscribe button and smash that notification bell so that you never miss another episode. Now, before we get into the main metrics, I wanted to mention market cap, simply because if a coin has a lower market cap, then less money is required to move the price. To me, this does play a big factor, and newer coins almost always have lower market caps. However, given the fact that most coins never gain momentum, hype, or mindshare, you have to look at many other factors to determine if a project is worth investing in or not. And so let's compare some of these other factors and how they stack up with newer tokens versus older tokens. The first metric to keep in mind regarding old and new cryptos is an all too familiar one, token supply. Older tokens tend to have more of their supply unlocked and circulating, while newer tokens usually have a whole load of new supply right below the surface. Let's take the veteran DeFi project Aave, for example. Launched as Lend back in 2017, 95% of Aave tokens are now unlocked. That means that you don't have to worry about some calendar cliff sneaking up on you next month and unleashing a wave of sell pressure. All that sounds good, and it is, especially for proven projects like Aave. However, it's important to consider governance. Now, while it's highly unlikely Aave's governance would push to increase its token supply, it could introduce new tokens as the protocol expands, and that can impact the value accrual for the original Aave token. Indeed, such proposals have been put forth recently, so stuff like this is something to monitor when it comes to older cryptos. Now, let's consider a newer DeFi token, Jupiter's Jupe. Launched in January of 2024, only 45% of Jupe's supply is currently in circulation. It's also worth noting that Jupe had a very different distribution model than Aave's ICO. Jupe's launch week saw $700 million worth of Jupe tokens land across almost 1 million Solana wallets via airdrops, a broad distribution that builds a user base, but also creates sell pressure as many recipients dump when they get free money. In January this year, Jupiter executed another large-scale airdrop of 700 million Jupe, and even telegraphed that another round is slated for next January. That's very welcome news for heavy users of Jupiter who stand to receive more free tokens, but it also tests the demand as new supply is unlocked. At the same time, it's important to note that governance could change things for new tokens as well. For example, in early 2025, 3 billion unissued Jupe were burned, cutting total supply by 30%. So new tokens can change their trajectory via governance in a way that older capped token models cannot. So which structure is better? Well, a mature float like Aave's is predictable, fewer nasty surprises for token holders. On the other side, dynamic floats like Jupe's can accelerate distribution and network effects, but also mean that supply is expanding, and it's not necessarily going to diamond handers. So the maths would seem to favor older projects that have less supply overhang, but there are behavioral factors that come into this too. To help decide, you could ask what older projects might be doing to revamp their tokenomics, and how that impacts the token. Equally, ask who's getting newly unlocked coins in new projects, and consider what they're incentivized to do next. Now, the second metric to keep in mind regarding old and new cryptos is accessibility. If a token is available on all established centralized exchanges, inside a brokerage account, or via a TradeFi investment wrapper like an ETF, it can be easily and passively bought by all market participants. Crucially, that includes those older non-crypto natives who have most of the money. By contrast, if a token sits exclusively behind a DEX, a bridge, or a hot wallet setup, even a screaming hot narrative could struggle to bring in buyers, simply because it's harder for crypto liquidity to flow to that token. That structural gap is why older cryptos are uniquely positioned in the market versus newer cryptos. Older cryptos tend to be more accessible. On that note though, let's look at what TradeFi investment wrappers like ETFs can mean for flows, starting with ETH. Back in August of this year, spot ETH ETFs cleared over $1 billion of net inflows in a single day, taking cumulative inflows into the tens of billions. That's all done through a few clicks in a TradeFi brokerage account. Insane numbers that new cryptos simply are not going to see. And the liquidity pipeline is widening too. Veteran coins like Doge, XRP, LTC, and ADA all have multiple US spot ETF filings and amendments currently being considered. Some newer tokens could see ETFs too, but market forecasters see a straightforward signal. Large cap, older names are the coins with the biggest odds to get spot ETFs next. Now, contrast that with new strong tokens that are performing well and gaining attention. Athena's ENA has ripped to a 7-month high on fresh stablecoin related catalysts, while Ondo had a strong summer as tokenized real-world asset headlines piled up. On-chain traction? Absolutely. But these do not sit in spot ETFs or other such products, and large cohorts of capital can't touch them as a result, even though they're at the heart of majorly bullish crypto narratives. So, performance without access for the biggest pools of capital could set up a cap on buying pressure. Now, it's important to note that recent market developments may change this pain point for newer tokens. For instance, we now have a new wave of digital asset treasury companies branching out from BTC and ETH to accumulate treasuries made up of other coins. The Athena Foundation itself has already backed a NASDAQ-bound DAT called Stablecoin X. It will be a firm with publicly traded stock that holds hundreds of millions of dollars worth of ENA as its corporate treasury. In practice, that means that traditional investors can get indirect equity exposure to ENA through a listed company, even if they can't buy the token outright. So yes, investor access is something that has typically favored older coins, and largely still does. But that story is changing, particularly as the market evolves and regulations shift to allow for new ways of accessing crypto that were previously unthinkable. And if you're looking to access some top cryptos, then you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. To get these goodies, all you need to do is hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click one of the sign up now buttons. Now remember, these deals, they won't be around forever, so take advantage of them while you still can using the link in the description below or the QR code on the screen. Now, the third metric to keep in mind regarding old and new cryptos is arguably the most important of all, and that is momentum. New cryptos tend to hijack social media feeds, compress the learning curve into a meme, and attach a narrative onto a fresh chart. In contrast, old cryptos come with bigger market caps, tired narratives, and legions of holders waiting to reach break-even. Let's consider one of the most hyped new tokens this cycle, Hyperliquid's Hype, pun intended. Launched in Q4 last year, Hype was an instant favorite, not only because the Hyperliquid DEX is a good product, but because of a record airdrop that cut VCs who dump on retail out of the equation. Hype has built on that momentum and gone from strength to strength. As is common in all markets, higher prices beget higher prices. Elsewhere, we have this cycle's leading meme coin launchpad and its recently launched token of the same name, Pump. Meme coins have been a leading narrative this cycle, and the pump.fun launchpad led the way. Pump ICO'd in July, and after an initial post-ICO sell-off, this token has managed to benefit from the platform's dominant position, and Pump has recently pumped to new all-time highs above its ICO price. Again, pun intended. Now, what kind of momentum do older cryptos have? Well, old doesn't mean dead, but older coins are often much heavier. Cardano's ADA offers some insight here. Although we are over 2 years into a bull trend for the crypto market, many older coins such as ADA are still far away from their previous all-time highs. For ADA, it's still 3.5x away from its previous all-time high. That doesn't mean that it won't reach it, but while new tokens enjoy price discovery, making new all-time highs, older coins face various levels of resistance on the way up. It's also more difficult for more mature cryptos to generate hype and momentum when they've already enjoyed many of the major milestones in the project's roadmap. Couple that with underwater holders eager to break even on long-term holdings, and it becomes even tougher for token prices to rise. With that said, older projects can certainly find the necessary catalysts. XRP didn't just bounce this cycle, it printed new all-time highs over the summer, showing that a long-standing brand could steal the spotlight from any newborn ticker. When the story is big enough, even the old cryptos can run hard and fast. Now, the fourth metric to keep in mind regarding old and new cryptos is another critical one, and that's user adoption. If a protocol is winning, you'll see it in throughput, market share, and active users. By crypto's nature, with heavy and frequent capital rotations, the shiny new tokens tend to do well here. Again, we can look at Hyperliquid, which steamrolled this cycle, setting a peak of around $30 billion in total daily trading volume back in August. That activity is, of course, reflected in Hype's price action, which has been incredibly strong since its launch. And the receipts keep stacking. In August, Hyperliquid printed a record volume of $400 billion and a record revenue of $110 million. Crypto has had its fair share of perp dexes that were once king of the hill, like GMX and DYDX, but they couldn't achieve adoption as they were arguably ahead of their time. That fact alone offers some proof as to how and why new crypto tokens outperform older ones. But it also brings into question whether a challenger will eventually dethrone Hyperliquid. That remains to be seen, and with the industry record numbers Hyperliquid is putting up, it's likely to be stickier as a market leader than previous competition. Now, let's switch things up and think of adoption among the old guard. Mature protocols often run into built-in hurdles. Usage kick-started by incentives fades once subsidies end. Original designs and roadmaps may find that they have to pivot to new market trends. That can be complicated by governance and compatibility issues. Plus, the associated token doesn't necessarily capture value even if the protocol adapts. Let's consider the case of Filecoin and its token File, an older data storage crypto that continues to be quite popular. But remember, adoption isn't measured in the number of wallets holding File, it's measured in the use of the Filecoin protocol to store data and retrieve it. According to Masari, Filecoin's utilization actually improved in Q2, but capacity providers churned as incentives normalized, with total storage capacity falling by 13% from the previous quarter, and only a fraction of its total stage being used. On the plus side, the team keeps shipping. They launched verifiable hot storage back in May, which is exactly what real users need. So it's important to remember that the teams behind older projects face tougher challenges in user retention. Yes, this does mean that they have more experienced teams to get the job done, but until paying recurring users show up and tokenomics tie that demand to their coins or tokens, there's a ceiling on how much the crypto in question can prosper. That said, the lesson here isn't complicated. Older tokens face challenges when trying to hold onto or recapture attention and users, especially as new projects emerge. Not only that, but these newer tokens get to learn from the mistakes of the predecessors. And if a new team can execute well from the get-go, usage in those early days can compound, and the project enjoys the spotlight. Well, for some time at least. Now, the fifth metric to keep in mind regarding old and new cryptos is project funding and community alignment. This cycle, there's been a palpable shift towards anti-VC sentiment, and many of this cycle's most successful projects and tokens have run with that. Once again, Hyperliquid is worth flagging. Hype didn't raise a classic venture round for its token launch, and it distributed one of crypto's biggest ever airdrops, worth $1.2 billion. And those tokens went to loyal platform users. Pump.fun also took an anti-VC route, albeit a slightly different one. It opted for a loud, public ICO with 33% of supply sold fully unlocked. That structure offered more value to everyday crypto users because big players weren't allowed to capture tokens at cheaper valuations, as is often the case. There's also a macro reason newer projects are less VC-backed and more community-focused. And that's because crypto VC funding isn't what it once was. Fund formation has fallen dramatically from the 2021 to 2022 peak, and liquidity providers have tightened up, even in a bull market. That means that it's harder to raise and allocations are pickier. Project investment numbers reflect this too. In the last cycle, VCs put over $60 billion into crypto startups across the peak years of froth between 2021 and 2022. In this cycle, there's been a major drop-off. 2024 totaled around $11.5 billion, and the first half of 2025 saw around $6.8 billion, according to Galaxy Research. Now, it's important to note that none of this means VC equals bad or old equals bad. In fact, the hybrid model, corporate muscle plus a rabid community, can be the most bullish backdrop of all. So the funding split this cycle is a structural shift. With fewer VC lifelines and more skepticism about tokenomics, newer tokens are proving that you could bootstrap with airdrops, on-chain revenue, and public sales that put users in the driver's seat. However, executing that is much easier said than done. And on the other hand, if done properly, having professional investors that help grow the project is undoubtedly a major advantage, as some older cryptos have proven. So that sums up the 5 metrics, but which cryptos come out on top, old or new? Well, on the supply dynamics, the edge easily goes to older cryptos. All else equal, less supply overhang makes it easier for prices to rise. On accessibility, it's older cryptos again. Top-tier listings and TradeFi products expose older coins to more buyers. However, like I mentioned before, newer tokens that will be listed on CEXs but aren't yet might provide the opportunity for bigger gains. When it comes to momentum and hype, the advantage definitely goes to new cryptos though. Attention, distribution, and fresh narratives can drum up momentum that older coins usually cannot. On adoption, new cryptos take the title again. This cycle's breakouts have the usage and the revenue. And this brings us to community and funding, where it's close, but new cryptos take the win again. Granted that they have community-first mechanics, buybacks, airdrops, and less VC involvement, which better aligns tokens with users. The final tally, new 3, old 2. New coins often dominate momentum, gain actual usage, and have cleaner community alignment. But make no mistake, the old cryptos command the rails that matter for TradeFi and big money. And when that machinery spins up behind a real product push, they can rise to unbelievable highs. In other words, new tokens take the prize, but older tokens can still stage monster rallies and even print new all-time highs when teams execute. If they do that, the weight of bag holders can actually turn from drag into velocity. Conversely, newer tokens both require and reward speed and investor savvy. Monitor unlock schedules, governance pivots, and on-chain metrics because they all move price. But that's just what we think. Do you agree or do you disagree? Let us know down in the comments. Also, if you're not subscribed to the channel yet, why not? You could do so by smashing that subscribe button right down there. Feel free to like the video too while you're at it. And if you want to learn about which Ethereum altcoins that we're bullish on, both old and new, you can watch that video right over here. As always, thank you so much for watching, and I'll see you again very soon. It's Lewis signing off.